Welcome to this episode of Into the Multiverse, where we are going to talk about navigating market volatility. Markets have been quite volatile, and as a participant, you would have probably noticed that September was a strong month for the Nifty, with the Nifty touching a new all-time high. And subsequent to that, you've actually seen a fairly steady drawdown through October as well as November. When we look at what happened in November, you had this steady sort of drawdown that was occurring for the first 3 weeks, and then you had a quick U-turn, and the market actually ended up flat in November with a minus 0.75% return for the month. At the same time, if we look at the peak to trough drawdown in this period, that has been almost 11% at 10.93%. So clearly investors have had a lot to do, and if you thought that this selling was going to continue, you would have probably avoided participating in equity markets through November, only to realize that the returns were not so bad and not as bad as we thought they would be. So clearly investors are in a situation where there's a lot to think about and there's a lot to trade off between, and it makes sense to actually have a strategy that allows us to navigate this market volatility. The first step that we can take is to acknowledge that markets will continue to be volatile. There are a few good reasons for this. Firstly, our earnings season was a little disappointing. Markets haven't fully factored that in yet. Second, there's been relentless FII selling through November with almost 46,000 crores going out of FII books. Third, the latest GDP data is actually a little bit disappointing, and while markets have not reacted negatively to it, there is scope that if we continue to see economic activity slow down, that markets will need to recalibrate their expectations. So in this context, there is enough and more room for forces to be pulling markets both up and down, creating that room for volatility. The second step that we can take is to actually diversify our portfolios and invest in asset classes that have a lower correlation with domestic equities. So this could mean looking at the precious metal baskets, adding fixed income into our portfolios, or even looking at global opportunities based on how attractive they are. The third way that you can effectively navigate volatility is to have some cash in place. So when we take cash calls, we create a little bit of flexibility to respond to volatility at the right time in the right way. And you can do this by either setting a higher savings target for 2025 compared to what you had for 2024, or you can also create liquidity within your portfolio by moving across asset classes or exiting investments that have performed really well, or at least booking profits so that there is some buffer and some protection that you have for the returns that you've already made. The last thing that we can do is to actually make a mindset shift, and this can occur if we decide to lower our return expectations. We've had a fantastic run in the markets, so if we temper how much we're expecting the markets to deliver, and if we acknowledge that we have to do more heavy lifting in 2025, then we are on a better wicket. Otherwise, what you can do is also lengthen your investment horizon. So if you've set a milestone that you want to achieve in 2025, then maybe that milestone might actually only occur in 2026 or 2027. So giving our portfolios that space to breathe and grow is a very important thing at this point. Of course, your best friend when it comes to navigating volatility is multi-asset investing. If you'd like to participate in a multi-asset PMS product like Sphere, let us know. You can get in touch with the number below.